You saved in your 401k for 30 years, and now the IRS wants their cut. Today, we're going to talk about the tax time bomb and the 4 stages that come along with it. See, most people think a 401k is a tax savings vehicle, but it is not. It's a tax delay vehicle, and delay is not the same as savings. The difference between those two words will cost the average high-income earner hundreds of thousands of dollars in retirement, and almost nobody sees it coming until it's too late to do anything about it. All right, we've got 4 stages. Stage 1 is the deferral delusion. Stage 2 is the growth trap. Stage 3 is the RMD Hammer. And stage 4 is the inheritance tax. I want to start by asking you a simple question. When you contribute to your 401k, what do you believe you're doing? See, most people would say that they're saving for retirement, they're building wealth, they're getting a tax advantage. And on the surface, all of that sounds right. You contribute pre-tax dollars, your taxable income goes down, you get a deduction today, and the money grows over time. And you feel like you're winning. But here's what nobody told you. You did not save on taxes. You delayed them. And delay is not the same as savings, not even close. Because when you delayed that tax bill, you handed control of it to a future version of yourself who has no idea what tax rates will look like in 15 or 20 years. And a future version of yourself who will be forced by law to start withdrawing money at a specific age, whether they need it or not. A future version of yourself whose heirs will inherit not a tax-free asset, but a tax liability. See, the 401k was sold to you as a tax advantage. And in a narrow technical sense, there is some truth to that. But the full picture, the picture that nobody shows you when you're sitting in an HR meeting filling out your enrollment forms, looks very different. So stay with me for the next 20 or so minutes, because understanding these 4 stages could change the way you think about every dollar you've saved. Let's get into it. My name is Adam Williams. I'm the founder and CEO of R.M.D. Capital, a private equity firm based in Scottsdale, Arizona. I've spent over 20 years studying how capital works, how income is built, and how the traditional financial system operates. Last year alone, we completed over $200 million in multifamily transactions and added over 1,300 units to our portfolio. I've sat across the table from hundreds of high-income earners who were doing everything their financial advisor told them to do, and still had a retirement plan with structural problems that they had never been shown. And this video is about one of the most expensive of those problems. Not because I want to alarm you, but because the earlier you understand how the tax mechanics of your retirement account actually work, the more options you'll have. And right now, most people have far fewer options than they realize because they waited way too long to ask the right questions. Let me paint 2 pictures. Same income, same discipline, same starting point, but 2 very different outcomes. Investor A is a 45-year-old physician. He earns $400,000 a year. He's been maxing out his 401k since he finished his residency. His balance is sitting at around $900,000, and he feels pretty good. His advisor tells him he's in great shape, he nods, he keeps contributing. What nobody has told him is that every single dollar in that account, every dollar he ever contributed, every dollar of growth, every dollar of compounding over the last 15 years is pre-tax. None of it's been touched by the IRS yet, and the IRS has been remarkably patient. They will collect. They always collect. The only question is when, and at what rate, and under what circumstances. Now let's look at an investor B. Investor B is the same age, same income, the same discipline, but somewhere along the way, someone sat down with her and walked through the full picture, not just the tax deduction today. The full picture, what the tax bill looks like at age 65, what happens at age 73 when withdrawals become mandatory, what her children will face when they inherit her account. She made very different decisions, not because she was smarter, but because she had information investor A had never received. Here's the core problem with how 401ks are sold to working Americans. The conversation's almost always about the contribution, the deduction today, the tax savings this year. The part of the story is real and it's genuinely useful. Reducing your taxable income during high income earning years has real value, but that's only the first chapter of the story. The chapters nobody reads until they're forced to are the ones that happen after you retire, after you stop contributing, after the government starts requiring you to take out money, after you die and your children are handed an account full of dollars they have never paid tax on, and now they're legally required to distribute within 10 years. Those chapters are where the tax time bomb detonates. Now let me walk you through all 4 stages. Here's what I want you to hold as we go through this. The 401k is not a bad vehicle. It was designed with real benefits, and for the right person in the right situation, those benefits are meaningful. But a tool is only useful if you understand how to use it and how it actually works. Not how it's marketed, but how it actually works. See, most people have only ever been shown the first page of the instruction manual. And today, I'm gonna walk you through the entire thing. Stage 1, the deferral illusion. When you contribute $24,500 to your 401k this year, the 2026 maximum for most workers, you reduce your taxable income by $24,500. And if you're in a 37% federal tax bracket, that saves you roughly $9,000 in taxes right now. And that feels like a win. And in isolation, it is. But here's the part of the math people skip. When you withdraw that $24,500 in retirement, it is taxed as ordinary income, every single dollar, at whatever rate applies at that time. So the question you have to ask is, what will my tax rate be in retirement? And most people assume it'll be lower. They assume that without a salary, their income will drop and their tax bracket will fall with it. That assumption is often completely wrong for high income earners. Here's why. First, Social Security benefits are partially taxable once your income crosses certain thresholds. Second, required minimum distributions, which we will get into in stage 3, can push your taxable income higher than you expected even after you stop working. And third, if you have built significant wealth across multiple accounts, your retirement income may not be dramatically lower than your working income. And fourth, nobody knows what tax rates will look like 15 or 20 years from now. The 2017 Tax Cuts and Jobs Act reduced rates for many taxpayers. Those deductions were set to expire after 2025. And whether Congress extended them, let them revert, or raised rates further to address the national debt, the point remains the same. You deferred at a rate you knew. You will pay at a rate you cannot fully control. You deferred, you did not save, and you handed control of the rate to a future you cannot predict. Let's get into stage 2. The growth trap. Here's the part that makes stage 1 significantly worse. It's not just the dollars you contributed that are sitting in a pre-tax account. It's every dollar of growth on top of those contributions. So let's say you contributed $300,000 over 15 years and your account has grown to $900,000. That means $600,000 of growth is sitting in the account alongside your original contributions, and all of it is pre-tax. All of it is waiting for the IRS to come knocking. So you did not defer taxes on $300,000. You deferred taxes on $900,000. And the longer the account grows, the bigger that deferred tax bill becomes. A $2 million 401k is not a $2 million asset. It's a $2 million asset with a tax lien on it. And the size of that lien depends on your future tax rate, your future income, and policy decisions made by people you'll never meet. Now think about what that means structurally. Every year your 401k grows, your future tax liability grows with it. The account balance going up feels like progress, and it is progress, but the tax bill growing alongside it is not showing up on your monthly statement. It's invisible until it's not. Compare that to an asset that grows in a tax-advantaged or tax-free structure, or even better yet, an asset that generates income that is already tax efficient by design. The growth you see is the growth you keep. No hidden lien, no invisible liability growing in the background. The 401k creates the illusion that everything in the account is yours. It is not. A meaningful portion of that belongs to the IRS. They're just being patient about collecting it. All right, let's get into stage 3. The RMD Hammer. At age 73, patience ends. Required minimum distributions, RMDs, are the government's mechanism for collecting the taxes you've been deferring your entire working life. And at age 73, the IRS requires you to begin withdrawing a minimum amount from your traditional 401k and IRA every single year, calculated based on your account balance and your life expectancy according to the IRS tables. You do not get to decide if the timing is good or bad from a tax perspective. You withdraw or you pay a penalty of 25% on the amount you were supposed to take, but you did not. And here's where it gets expensive for people who have been successful. You've built a significant 401k balance, let's say $2 million. Your RMD at age 73 is roughly $75,000 to $80,000, and that's taxable income stacked on top of your Social Security, stacked on top of any other income you have, and it grows every single year as the calculation adjusts. For many high-income earners, RMDs push them into a tax bracket in retirement that is equal to or higher than their bracket during their working years. The deferral strategy that was supposed to reduce their tax burden ends up doing the exact opposite. And it gets worse if the account has continued to grow. A $3 million 401k at 73 generates a larger RMD than a $2 million account. The more successful your investment strategies inside the account, the larger your mandatory withdrawal and the larger the tax hit. You built a bigger account, but the IRS built a bigger tax bill to match. And there's no opt-out. There's no negotiation. At age 73, the hammer falls. All right, and finally, stage 4, the inheritance tax. See, most people work their entire lives with the hope of leaving something meaningful behind for their children, for their grandchildren, for the causes they care about. And here's what actually happens when a traditional 401k or IRA has passed to a non-spouse beneficiary. They inherit a tax liability. Every dollar in the account is still pre-tax. Your heirs did not contribute to it. They did not get the deduction, but they will pay the taxes at their ordinary income rate in the years they receive the distributions. And thanks to the Secure Act of 2019, most non-spouse beneficiaries can no longer stretch those distributions over their lifetime. They are required to fully distribute the account within 10 years of the original owner's death. Think about what that means in practice. Your child is in their peak earning years, probably in their 40s or 50s, likely in a high bracket. They inherit a $1 million 401k. They're required to withdraw it all within 10 years. Those withdrawals stacked on top of their own income for 10 years, they're paying ordinary income tax on distributions from an account they never contributed to at the worst possible time in their tax life. A $1 million 401k inheritance might net your child $550,000, maybe $600,000 after taxes. Depending on their bracket and the timing, it could be less. You worked 40 years to leave them $1 million, and the IRS just took $400,000 off the top. That is not a tax advantage. That's a tax ambush. Deferred, compounded, and delivered to the people you love at the worst time possible. Now, let me put some real numbers on this so it's not abstract. Two investors, both 65 years old, both retiring with $2 million in savings. Investor A has $2 million entirely in a traditional 401k. Every single dollar is pre-tax. His advisor runs the 4% rule and tells him he can withdraw about $80,000 a year. What his advisor does not show him clearly is that the $80,000 withdrawal is fully taxable. In the 22% federal tax bracket, that's $17,600 in federal taxes annually before any state taxes. So his actual spendable income is somewhere around $58,000 to $62,000 a year, not $80,000. At 73, his RMDs kick in. And by then, if the account has grown modestly, his required withdrawal may be $90,000 or more. He does not need $90,000, but he has to take it. He has to pay tax on it. And the IRS is going to force him to do that. And the forced income may cause his Social Security benefits to become more heavily taxed and potentially reduce certain Medicare premium subsidies through the IRMAA surcharges. When he dies at age 87, his $1.4 million remaining balance passes on to his two adult children. Let's say they're in their late 50s, high income earners. They have 10 years to distribute the account. Each year they take distributions on top of their own income, the effective tax rate on the inheritance could be 30% or higher. So his $2 million account, built over 40 years, nets his children somewhere around $980,000 after taxes. Now let's look at investor B. Same $2 million, but she structured her capital differently over the years. A portion is in tax advantage structures that have already been taxed. A portion is in assets that generate income that is treated differently by the tax code: depreciation, capital gains rates, and return of capital. She has worked with a tax-aware advisor to manage the composition of her capital, not just the size of it. Her retirement income is not taxed as ordinary income. Her RMDs are smaller because less of her capital is in pre-tax accounts. Her heirs inherit assets with more favorable tax treatment. Same $2 million starting point, significantly different tax outcome over 20 years. You see, structure matters, not just how much you save, but how it's held. So here's the question I want sitting with you right now. If a meaningful portion of your 401k balance is going to be collected by the IRS at a rate you cannot predict, at a time you cannot fully control, in a structure that may punish your heirs during their peak earning years, how much of your retirement strategy should be built around that single vehicle? That's not a rhetorical question. It's a planning question. And the answer starts with understanding that there are structures that treat capital and income differently from the way that traditional retirement system does. Now let me talk to you about what those look like. The core problem with the 401k tax strategy is that it optimizes for one thing: reducing taxable income today. And it does that reasonably well. What it does not do is think about the full life cycle of that capital, what the tax picture looks like when your distributions begin, what it looks like when RMDs are forced, what it looks like when the account passes on to the next generation. A tax-aware capital strategy does not just ask, how do I reduce my taxes today? It asks three questions across the full timeline. Question number one, what is the tax character of my income? See, not all income is taxed the same way. Ordinary income, wages, traditional 401k distributions, most interest is taxed at the highest rates. Long-term capital gains are taxed at much lower rates. So certain investment income may benefit from depreciation offsets that reduce taxable income significantly. Return of capital is not taxed until all the basis is recovered. A tax-aware investor thinks carefully about the character of their income across their lifetime, not just the amount. High-income earners who have built significant 401k balances often have a portfolio that is almost entirely composed of future ordinary income. Everything in the account will eventually be taxed at the highest applicable rates. And that's the structural problem that has nothing to do with how well your investments performed. Question 2, when do I control the timing of my tax events? One of the most valuable things in tax planning is optionality, the ability to choose when you recognize income. The 401k takes that optionality away from you at age 73 when RMDs force recognition of the government's schedule, not yours. Capital structures that give you control over when and how you recognize income, Roth conversions done strategically during low-income years, assets with flexible distribution timing, and structures that generate income you can manage preserve your optionality. And that optionality has a real dollar value. Question number 3, what does my heir inherit, asset or a liability? This question almost never gets asked in the original retirement planning conversation, but it is one of the most important questions in the entire picture. An asset that passes to your heirs with favorable tax treatment, a step up in cost basis, tax-free distributions, assets that are already taxed, multiplies the value of what you leave behind. An asset that passes with a full pre-tax liability attached, like a traditional 401k, diminishes the value of what you leave behind, sometimes dramatically. Legacy planning is not just about the size of what you accumulate, it's about the tax character of what transfers. None of this means the 401k is worthless. For the right person in the right situation with a thoughtful long-term tax strategy around it, it still has real value. The employer match alone is often worth capturing, but it should never be the entire plan, and it should never be accepted uncritically as a tax advantage without understanding all 4 stages of how the tax mechanics actually unfold. I had a conversation not long ago with a business owner. He had sold a company a few years earlier, and he rolled the proceeds into a combination of investments, including a substantial traditional IRA. His balance was around $3.2 million. He had been advised that the IRA was the right vehicle for the bulk of his retirement savings. When I walked him through the 4 stages, the deferral illusion, the growth trap, the RMD hammer, and the inheritance tax, his first response was frustration, not at me, but at himself. He said, I specifically asked my advisor about taxes when I was setting this up. He told me the IRA was the most tax-efficient vehicle available. And I told him, your advisor was not wrong about the efficiency of the contribution. The deduction was real, the tax deferral growth was real. What he may not have walked you through is what happens at the other end. He sat quietly for a few minutes, and then he said, so what do I do now? I can't undo the last 5 years. And this is the part of the conversation I want you to really be clear about. You cannot undo what has already been contributed. What is in the account is in the account, but you have more options than you think from here. Roth conversions during lower income years can move pre-tax dollars into a tax-free structure, paying the tax now at a known rate rather than deferring it to an unknown future rate. Strategic charitable giving vehicles can absorb RMD income in tax-efficient ways, and capital structures that generate income with favorable tax character can reduce your dependence on the 401k for retirement income, which means smaller RMDs, more control, and a better outcome for your heirs. The best time to address a tax problem is before it becomes a tax crisis. And for most people with significant 401k balances, the tax crisis is not inevitable. It is avoidable with the right structure and the right planning horizon. He did not undo the last 5 years, but he made very different decisions about the next 5 years. And that difference will matter enormously when year 73 arrives. Now I want to give you a framework for evaluating the tax health of your retirement plan. I call it the T.A.X.E.S test. 6 questions, 1 for each letter. T, timing. Do you control when you recognize income, or does the government control it for you? If RMDs will force you to take income you do not need at a time that is bad for your tax picture, you have a timing problem. The earlier you identify it, the more options you have to address it. A, assets. What is the tax character of what you're doing? Ordinary income assets, capital gains assets, tax-free assets, and return of capital assets are all treated differently. A retirement plan that is 100% ordinary income is structurally vulnerable. Diversifying the tax character of your assets, not just the investment type, is one of the highest value moves an investor can make. X, exit. What happens to the capital when you're gone? This is the inheritance question. Does what you leave behind transfer as an asset or a liability? If your heirs will inherit a significant pre-tax account and they face a 10-year distribution window, the tax impact on the legacy you intended to leave is substantial. You should know the number before it surprises your family. E, efficiency. Are you paying taxes at the lowest available rate on this income? Not all income has to be taxed as ordinary income. Understanding which structures generate which tax character and building your capital accordingly is the difference between paying 37 cents on every dollar and paying significantly less. S, strategy. Does your advisor have a tax plan for your retirement or just an investment plan? Investment management and tax planning are different disciplines. Many financial advisors are skilled investors, but poor tax strategists. If your advisor has never walked you through the full tax lifecycle of your retirement accounts, contribution, growth, distribution, and inheritance, you have an incomplete plan. So run your retirement picture through the T.A.X.E.S test, not to feel behind, but to understand where the gaps are and how much runway you have to address them. I want to tell you something that shaped how I think about all of this. One of the things that drew me to the way I invest and the way I structure capital for people who invest with us is the concept of tax efficiency as a feature, not an afterthought. Early in my investing career, I learned something that stuck with me. It's not just about what you make, it's about what you keep. And what you keep is a function of structure, not just performance. I've watched incredibly disciplined investors. I'm talking about people who saved more than almost anyone around them, who were patient, who stayed the course through multiple market cycles, arrived at retirement, and discovered that a significant portion of what they built was already spoken for, not by a bad investment, not by a market crash, but by a tax bill that had been quietly growing in the background for 30 years. That is not a market failure. That's a planning failure. And it is almost entirely preventable. My wife and I think about this for our own family the same way we think about it for our investors. What is the tax character of what we're building? Who controls the timing? What does this look like when it passes to the next generation? Those are not complicated questions, but they are questions that require someone to ask them. And in my experience, they're questions that most people never get asked because the system that is supposed to help them plan their retirement is not designed around those questions. It's designed around accumulation, around products, around assets under management. Your tax bill is not your advisor's problem, it's yours. The best gift you can give yourself right now is to make it a priority before the government makes it one for you. There are two types of investors. There's the accumulation investor, the one who measures success by the size of the balance, who contributes faithfully, watches the number go up, and feels secure because the account is growing, who has never looked at the full tax life cycle of what they're building, the deferral, the growth trap, the RMD, and the inheritance, who will be surprised somewhere between 70 and 80 years old by the tax bill that has been growing quietly for decades. A big balance is not the same as a secure retirement, not if a meaningful portion of it belongs to the IRS. And then there's the tax-aware investor, the one who asks a different set of questions, not just how much am I accumulating, but what is the tax character of what I'm building? When do I control the timing? What does my family actually inherit? Who treats tax efficiency not as an afterthought, but as a design principle. The tax-aware investor does not necessarily earn more because they understood the rules of the game before the game was over. You can be that investor. The tax bill is coming either way. The only question is whether you see it coming in time to do something about it. If this video opened your eyes to something in your retirement plan that you had not fully considered, if you're sitting there wondering what the real tax picture looks like for the capital you've built, I want to invite you to have a real conversation. At T.A.X.E.S Capital, we work with accredited investors who are thinking carefully about not just how much they accumulate, but how much is structured, what it produces, and what it leaves behind. We are not tax advisors, and this is not tax advice, but we think about these questions every day, and we work with people who do. The link to book a call with our team is in the description below. We'll take the time to understand where you are, what you've built, and whether the way we think about capital structure makes sense for your situation. And if you want to keep learning, subscribe to this channel. We publish new content every week on how to think about capital, income, structure, and building wealth that actually lasts. I'll see you on the next one.